Welcome to the Slop Farm. Enjoy the video.
In this video, I will explain how to calculate a debtor's ledger. First, understand that a debtor's ledger is a subsidiary ledger that records all transactions with credit customers. It helps businesses keep track of who owes them money and how much. Each customer has a separate account, detailing sales, payments, and any adjustments. This system is crucial for managing accounts receivable effectively and ensuring accurate financial reporting. To begin recording, debit the customer's account for every credit sale made. This increases their outstanding balance. When a customer makes a payment, you will credit their account, reducing the amount they owe. Remember to also record any sales returns or allowances by crediting the customer's account, as this decreases their debt. Accurate and timely entry of these transactions is vital for maintaining correct balances. Once all transactions are recorded, calculate the balance for each customer. First, add up all the debit entries in their account. Then, sum all the credit entries. Finally, subtract the total credits from the total debits. The resulting figure is the customer's closing balance, representing the amount they still owe the business. This process is repeated for every customer in the ledger. The debtor's ledger is essential for monitoring customer payment patterns and managing cash flow. Regularly reconcile the total balance of all individual customer accounts in the debtor's ledger with the accounts receivable control account in the general ledger. This ensures accuracy across your financial records. For more great tips and deals, including the Echo Dot smart speaker, check the description below. Maintaining a precise debtor's ledger is key to healthy business finances.
Thanks for watching. Consider subscribing if we helped you today.